All right, let's talk about two of the most essential tools in any trader's kit, the simple and the exponential moving averages. You've definitely seen them on charts, but what's the real difference between them? And which one should you actually be using? We're going to break it all down. Let's dive in.
So, you pull up a chart, and what do you see? It's just chaos, right? A zigzag of ups and downs, all that daily noise that can make it almost impossible to see what's really going on. The big question for every single trader is, how do you find the real trend in all that mess? Well, that's exactly what we're going to tackle today.
And here's our game plan. First, we'll talk about decoding market trends in general. Then we'll dig into the SMA, followed by the EMA. After that, we'll put them head-to-head to figure out which one might be better for you, and we'll finish up with the main trader's takeaway.
Okay, first up, decoding market trends. The whole idea here is to find a way to smooth out all those crazy price swings so we can actually see clearly what the market is trying to do. And that's exactly what moving averages are for. They're basically these awesome tools that take all that messy price data and turn it into one smooth, easy-to-read line. This line is what lets us see the underlying trend without getting sidetracked by all the daily noise. So let's look at the two most popular types, starting with the classic. So that brings us to the SMA, the simple moving average. You can think of this as the original, the foundational tool. It's straightforward, and it's where pretty much every trader gets their start.
And it really is what it sounds like. A simple moving average is just, well, the simple average of a price over a certain number of days. And here's the most important part to remember. Every single price in that period gets the exact same weight. Day 1 matters just as much as day 20. No favorites.
Okay, let's put some numbers to this. Imagine these are the closing prices for a stock over the last 20 days. You can see it starts at $10, goes up and down, and ends at 18. To get our SMA, we've got to use every single one of these data points.
And honestly, the math couldn't be easier. Step 1, you add up all those closing prices for the 20 days. Step 2, you divide that big number by 20. That is literally it.
So, if we do that with our example, all those prices add up to 311. We divide that by 20, and voila! Our 20-day SMA is $15.55. That one number becomes our first point on that smooth line we're trying to draw. But, and this is a big but, here's the catch. Remember how it treats all data the same? Well, that's also its biggest weakness. The price from 20 days ago has just as much influence as the price from yesterday. And as this quote gets at, that means the SMA can be kind of slow. It relies on old data, which means it can lag a lot.
And that lag is precisely why we need another tool. So enter the EMA, the Exponential Moving Average. This one is all about reacting faster and prioritizing what's happening in the market right now. And this really sums up the whole philosophy. If the SMA gives equal weight to everything, the EMA is all about prioritizing the most recent data. It's built on a really simple idea. What happened yesterday is way more important than what happened 3 weeks ago. Makes sense, right? So yeah, the official definition is that the EMA puts way more weight and significance on the most recent data points. This just makes it more sensitive. It reacts faster to new information. And that's why you see a lot of active traders using it. They need to be quick on their feet.
So how does it actually do that? Well, it uses a little something called a multiplier. Now don't worry, we're not going to get bogged down in the formula, but the concept is really important. With a 20-day EMA, the most recent price gets about a 9.5% weight in the calculation. But check this out, if you shrink that to a 10-day EMA, the weight for the newest price jumps to over 18%. So the key takeaway here is a shorter period makes for a much more reactive EMA.
All right, so this brings us to the main event. Which one is better, SMA or EMA? Well, the truth is, it's not about which one is better overall, but which one is the right tool for your strategy.
And this chart breaks it down perfectly. The SMA is less sensitive, which means it lags, but that also means it's great for identifying those big, long-term trends. It smooths everything out. The EMA, on the other hand, is way faster and more sensitive. It's awesome for catching short-term moves, but it can also give you a lot of false signals when the market isn't really going anywhere. It's a classic trade-off, speed versus stability.
So how does this look in practice? Well, you'll often see short-term traders using something like an 8 or 20-day EMA because they need that speed. But for long-term investors looking at the bigger picture, they're more likely to use a 50-day or even the famous 200-day moving average, and they might use either an SMA or an EMA for that.
Okay, let's bring this all home. What's the big takeaway? For you, the trader. How do you actually apply this stuff to your own charts?
First things first, let's be real. No single moving average is a crystal ball. It is not going to guarantee you success. As the quote says, they're just tools, and like any tool, they have their strengths and their weaknesses.
So, to sum it all up, want a steady, smooth view of a long-term trend? Use the SMA. Need a faster signal to catch quick moves? The EMA is what you're looking for. The bottom line is that the best choice really, truly depends on your personal trading style and what you're trying to accomplish. So there you have it. You know the tools now. You know how to cut through the noise and spot the trend. You know the difference between slow and steady versus fast and reactive. So the real question is, how are you going to use them to read the charts?